Mitt Romney likes to joke that, quote, "You might have heard I was successful in business." And you might have. It's kind of what we'd call a humble brag. But it's also true. Romney has done very well in business. And in April, he told students at Otterbein University in Ohio how they could do well, too.
This kind of divisiveness, this attack of success, is very different than what we've seen in our country's history. We've always encouraged young people, take a shot, go for it. Take a risk, get the education, borrow money if you have to from your parents, start a business.
Got that, kids? Borrow money if you have to from your parents. Start a business. That is Mitt Romney's advice to young Americans. Forget, go west. Now it's call mom and dad and ask for a bit of help. Mr. Romney's economic strategy got a lot of attention, much of it sneering. But that really was his advice to the young entrepreneurs, and it wasn't the first time. In a 1994 interview with Ann Romney, the candidate's wife explained to the Boston Globe how she and her husband made ends meet in college. Quote, "They were not easy years. You have to understand I was raised in a lovely neighborhood, as was Mitt, and at BYU we moved into a $62 a month basement apartment with a cement floor and lived there 2 years as students with no income. It was tiny. And I didn't have money to carpet the floor. But you can get remnant samples, so I glued them together, all different colors. It looked awful, but it was carpeting. We were happy, studying hard. Neither one of us had a job because Mitt had enough of an investment from stock that we could sell off a little at a time. The stock came from Mitt's father." Given Mitt Romney's family background, that might seem like a natural recourse. Sell off a little of the family stock to get you through college. Helps you squeak by while you're taking a risk, getting an education. Nobody is saying that Mitt Romney got 2 degrees from Harvard without being smart, or that he became a success in business without working hard. When he says that would-be business owners should borrow money from their parents, he's actually talking about something real, about a common way that people in America, even non-rich people, do start a business. Right around the time Mr. Romney gave that advice about leaning on the family wealth, Nobel laureate economist Peter Diamond told me something about how he sees job creation working in the economy. Peter Diamond said, quote, "High earners tend to have high wealth. The rest of the population, however, has very little access to wealth outside of their housing. So if you want to encourage dynamism in the economy, it's more important to get money into their hands than to get it to those who already have a lot of wealth." What he's saying, in simple terms, is the rich tend to get richer, in part because they have wealth in the first place that they can use to invest. If you have wealth, or your parents do, then you can use that wealth to open a store, start a firm, build a factory. With that wealth comes the ability to take the risks that Mitt Romney so passionately wishes for Americans. You can try and you can fail, and then you can bounce back and try again. You're not living every moment on a tightrope. But if you're not rich already, then to the extent that you have wealth, it's probably in the value of your house. It's part of why we set up tax policy to encourage home ownership in this country. For average Americans, home sweet home has also meant wealth, sweet wealth, however modest. During this campaign season, Republicans have made a point of saying we don't need to worry about income inequality nearly so much as the equality of opportunity. That's the distinction drawn by Congressman Paul Ryan, the shaper and hero of Republican economic policy, when he talks about his vision for the country.
I think it's not good for the country, and I think it does come from a difference in philosophy, which is the American idea is to promote equality of opportunity so people can make the most of their lives.
To a very real extent, Paul Ryan and his fellow Republicans are exactly right on this. Equality of opportunity is one of the ways you fix income inequality and one of the most important elements in a dynamic economy. Maybe you're broke today, but if you have a fair chance, if you have equal opportunity, then you can still find a way to be better off tomorrow. And if you follow along that path, you can get a job, you can buy up a little house, and maybe you can build up some wealth. But that's the key. One of the key contributors to opportunity is wealth, and inequality of wealth is even worse than inequality of income. In 2007, before the recession, the top 1% had 21% of the national income share, but 35% of the national wealth. And after the recession, it's not good. According to new figures from the Federal Reserve, the median net worth of families fell by almost 40% during the Great Recession. In 2010, Americans found themselves at the economic level of 1992. 2 decades of economic progress wiped out in one horrifying freefall. Most of that loss came because the value of homeowners' homes fell by 42%, draining their main pool of wealth. If you dive into the report from the Federal Reserve, you'll see that the wealthiest families suffered least because they had other kinds of wealth, not just houses. At this point in the recovery from the Great Recession, the types of wealth that rich Americans have has come back. If you hold a lot of stocks, if you invest in corporations or emerging markets, then bully for you. The stock market has bounced back substantially from the dark days of 2008. So wealth inequality is actually up, which means inequality of opportunity is up too. Joining us now is Elon Mui, my colleague at the Washington Post and a reporter who spent a lot of time swimming around inside the new data from the Federal Reserve. Elon, thanks for being here.
Thanks for having me, Ezra.
So, what happened here? How did it fall so fast? I mean, 40% is very, very, very quick. It's a whole lost generation in wealth building, if I'm not wrong.
Yeah, I think that that's what's really interesting about this data is that the span of time that it has set us back, 20 years, that's, before the internet was even widespread. I'm not even going to ask you how old you were. I won't tell you how old I was at that time. But 20 years of wealth has been lost in just a 3-year time period. And that really put some perspective on both how deep the wounds of the financial crisis were and how long it could possibly take us to recover. We lost it in a very short period of time, but we're not going to get it back in that period of time. We've already seen the recovery, be slow.
Now, the Federal Reserve data, when you look at economic data, a house is wealth. The equity you have in your house is wealth. And it is for most Americans, for middle-income Americans, the main kind of wealth they tend to have. But does it feel that way to them? I mean, it's not liquid in the way that you can just sell a stock or sell a bond is. I mean, if you sell your house, you actually need somewhere else to live, which is going to also cost you money. So when we say that we've lost 40% of our wealth, is that how it feels to people? And does it then have the knock-on effects in the economy that you would expect from that kind of a wealth drop?
Yeah, I think it does. I think there are two things. One is that you say it's not liquid, you'd have to move somewhere else, but you also have to remember that a lot of folks took out home equity loans. A lot of folks did tap into sort of the rising paper value of their homes. But more broadly, it speaks to something that we call the wealth effect, right? That even if you haven't realized the gains on your home or realized these increases in prices, that it makes you feel more wealthy, and so that can affect the way that you spend money, can affect the way that maybe you go out to dinner more often, maybe you go shop at the mall more often, and all those things help fuel the economy. Consumer spending, as you know, is 2/3 of GDP, so you have this sense of people feel like I'm secure, that I have a safety net, and so that can affect people's spending. Now we're seeing the reverse happen. Even if I'm still in the same home, even if I didn't take out a HELOC, now I feel less wealthy because my home value is less, at least on paper, and so I'm going to alter my spending and alter my behavior because of that.
Right, and one of the things a lot of people did when they would take out a new line on a home, because you can get a fair amount of money off of a mortgage like that, is they would send a kid to college. They would start a small business. We've seen in the last couple of years the lowest rate of new business creation we've seen for a very, very long time. And so to go to the sort of underlying question here, is this kind of a loss in wealth going to lead to a different sort of set of economic winners going forward? Would we expect to see different sort of folks at the top of the income ladder in 20 years because different kinds of folks are going to have the opportunity to invest and realize those gains starting now?
What the Federal Reserve actually found is that there was mobility in the middle, but not really so much on the outside. So you had the folks who were bad off to begin with, they stayed bad off. Mm-hmm. The folks who were at the top of the spectrum stayed at the top of the spectrum. But what you found was that only half of the people who were in that middle clump or in the middle class actually stayed where they were in 2007 by the end of 2010. There was a lot of movement there. Some folks went from being upper middle class to lower middle class. Some folks actually went from being lower middle class to middle class. There's movement in both directions, but there was actually a lot of mobility in that area because of the volatile price of housing. And so I think that you may see some, again, movement in the middle, but to jump from the middle class to that top 10% requires an exponential leap in wealth. I mean, the net worth of the top 10% is something like over $1 million. Oh. So, it's increasingly hard to get to that top 10%, even though there's a lot of fluctuation in the center.
Elon Mui, colleague at the Washington Post, thank you for getting through all this data for us. You make it look easy.
Thanks so much, Ezra.